Rohr here with an early concise highlight on Friday, October 17th, 2014. It is currently about 7 a.m. U.S. Central Time, and as opposed to the major global view from yesterday, this is indeed going to be very concise today because we see everything in foreign exchange exactly the same as yesterday. And the macro factors affecting the market have cleaned up to some degree. Now it's time to ask just what all that might mean to the markets. And again, we think the Ebola factor, in that it's sounding like the initial worries about the additional cases in the U.S. is definitely abating in the wake of the more prominent congressional hearings yesterday. And that has left the S&P 500 December future up $22 today at 1873. And this is important because it's back above the gap lower when the market dropped on Wednesday below the near-term double bottom from the weakness in the 1865 on Monday that was matched by the weakness later on in the session after the attempt to recover on Tuesday. And then you had your gap lower below it Wednesday morning that led to the spill. But lest anyone forget, we had noted that the next lower important level below 1885 was 1850 to 45. And when that was knocked out early on Wednesday, it allowed the market to get down near the major weekly channel support down into the 1810 to 08 area when it bottomed into lunchtime on Wednesday into 1814. And most interestingly, now that would still be support. That's where the channel moves up to next week, with still a buffer to about 1808. There was a major April sharp sell-off trading low back in that area, and we had an up break along the way that the market has held so far at about 1842, and now we're looking at the further recovery above 1865, another interim level, probably pointing toward a test of the failed up break and previous hefty congestion in the 1882 to 85 area. The extended resistance is still up around the old gaps and August trading low right in the 1900, and those are the levels and the fact that the bias looks up right now. Especially consider that after such a long time, and note that ever since the market got back in trouble, let's go back to last week, Thursday, in the wake of the positive response to the FOMC minutes on Wednesday. I mean, this is a $50 rally out of 1920 back up to 1970, essentially. Overnight trading, it hit 1970. That we would be looking at Thursday's weakness last week. And once it fed on itself into lunchtime and later, the market got back below key levels like the 1930 area or so, that ever since then, the hourly MACD, in spite of all of the attempts to bounce from lows, has remained below its lower runaway band until later on yesterday. And this was very important in terms of right at the point when it was cleaning up back above that is also the point at which it was trading back above 1865 to close off that gap. Even though it faded a bit back below it later in the day, this substantially, for the first time in a week, took the downside momentum away from the bears. And we're seeing the follow-on implication of that this morning. And that's pretty much it for the short-term view of the S&P.